Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I would like to talk about Div 293, which is a tax on super contributions. We're going to talk about, what is it? Can you avoid it? Are there any other matters that you need to take into account? So let me begin by explaining what Div 293 tax is. Essentially, when we make concessional contributions into super, they are taxed at a flat rate of 15% for most people. And concessional contribution is either a personal tax deductible contribution or an employer contribution, which is the superannuation guarantee that's paid on your behalf. And as I said, it's normally taxed at a flat 15%. The government brought in a few years ago an additional tax for higher income earners. And the reason is that if you pay 15% in super, whereas you pay 47% outside of super, you're 32% better off. Whereas for lower income earners, they might be paying sort of 30% or even less. So there's a much smaller tax benefit to lower income earners. And the government thought that it was only fairer then that higher income earners shouldn't benefit from such a large tax deduction. So therefore, after you lodge your tax return each year, if your adjusted taxable income is above $250,000, the ATO will send you a bill for an amount equal to a further 15% on your concessional contributions. So therefore, your contributions tax in total by 30%. So, I mean, is it worthwhile paying the additional or making those additional contributions and paying that tax?
Well, you're the financial planner, Stuart, so you should really answer that question. But it is my belief that you should still make those additional contributions because you're still that 17% ahead between the 30 and the 47. And obviously, you're setting away that nest egg away for your future retirement.
Yeah, that's right. Look, and you can't avoid Div 293 tax either. I mean, you can avoid it if you reduce your super contributions, but a lot of people's contributions are coming from their employer and they're mandated, which means that they're compulsory. So there's not much wriggle room around being able to minimise tax, Div 293 tax in this instance.
So I might just jump in there, Stuart, unless, of course, you're self-employed. You can sort of manipulate your salary a little bit or your earnings to reduce or bring you down below the $250,000 threshold.
Yeah, definitely. I mean, obviously, if you're self-employed and your personal taxable income's less than $250,000, obviously you're not going to pay the tax. And that's something I guess you want to think about when deciding how you distribute your profit. Once you get the bill, you'll have two options. You can either pay for that tax personally or you can ask your super fund to pay for it. I would typically encourage people to pay for it personally. The whole goal with superannuation is to try and to get as much into super as possible, because by the time we're 60, at least at this stage, we can have up to $1.9 million each, which is 3.8 across couple, if you've got a spouse, inside super that's tax-free. So really the goal would be to try and have as much of that wealth inside super as possible, and therefore by paying that 293 tax personally, you're leaving more money in super. Now, if you don't have the personal cash flow to be able to do that, of course, take it from super, but paying it personally is probably a good idea.
So you usually get the option, if you breach the concessional cap, some employers will allow you to take the additional funds personally or continue to make contributions into super. So what we typically advise is it's very unique to your situation. So for example, if you've got a very high home loan debt, then it might be in your best interest to actually take those funds personally to reduce your debt. But if you've got a healthy surplus of cash flow, very low debt levels, then we'll typically advise clients to continue contributing into super.
So there you go. That's just a brief introduction to Div 293 tax. Yes, any additional tax is not something that we'd normally welcome, but still it's worthwhile contributing to super. You're saving 17% because if you took the money in cash, you'd pay 47%. So you're still better off. And it's really about ultimately building retirement savings. Okay, until next week, bye for now.